Okay, so now that we've talked about expected return and standard deviation and variance, we need to acknowledge that there are some caveats to that first part of this lecture. And the biggest caveat is that when we calculate expected return, while the math is all still fine and is all still appropriate, it relies on a couple of really major assumptions. Namely, that we know the future states of the world, that we know how many future states of the world there are, what the probabilities of those states are occurring, and then what the actual outcomes are, what the actual returns are. And if we know all that, then we can perfectly calculate expected return and estimate the risk of any investment or any asset. But what's the likelihood that we can actually observe any of those things in practice? And the answer, of course, is that it's pretty slim. So while we have looked at the sort of math that underlies the idea of risk and return, we haven't really come yet to a really practical way to use that in our day-to-day investing or in our business world. So what we're going to do in this second part is twofold. And the second problem. Right? The second problem is that we noticed at the very end when we looked at portfolios that portfolios seem to break one of the fundamental rules of finance, which is that risk and return trade off one for one. Right? More risk, more return, less risk, less return. But what we saw when we formed a portfolio was that we were able to combine a certain number of assets or certain kinds of assets into a collection that simultaneously reduced risk more than it reduced return. And based on our understanding of the rule, that shouldn't be possible. Right? So what that means is that not only do we not have all the full information that we need to calculate expected return and risk in that way, it must be that we are misrepresenting the type of risk that the fundamental rule is all about. In other words, if I'm able to reduce the standard deviation by forming a portfolio, it's probably because standard deviation is not the best measure of the kind of risk that investors care about. And that's the kind of risk that that generates return. Okay? So we got to do two things in this part. We first dig a little deeper into the risk. Why is it that a portfolio can reduce the standard deviation? And because it can do that, can we find a better measure of risk that more appropriately fits our fundamental rule? And then two, can we, in part by using that a better measure of risk, can we figure out a more practical way to estimate the expected return of an asset when we don't know any of the information about the possible states of the future? Okay? So that's where we're headed. And to start, let's talk about the risk. Right? And as it turns out, the reason why forming a portfolio can reduce our risk more than it reduces return is because we can split risk into two different categories. And only one of those risks provides a valuable return. And that's this first type of risk. It's called systematic risk or market risk. Right? And systematic risk is a risk characteristic that affects every asset in the market. And because of this, it's known sometimes as market risk. It's also known as non-diversifiable risk, which we'll talk about in a little bit, what non-diversifiable means. But you can think of systematic risk as a risk that affects the entire system. Right? And the entire system is everything in the market. So these are all the gigantic things that you might think of that might affect a market, either in a good or a bad way. Right? So you can think that certainly we're experiencing a systematic risk right now, a sort of unprecedented one in the form of a global pandemic that has completely shuttered economies across the world. And we're now entering a recession as deep as any we've been in since the 1930s during the Great Depression. Okay? You could think about a war as a systematic risk. And of course, it also doesn't have to be that significant of a factor. We also have things like inflation. Right? Inflation affects everything in the stock market. Interest rates, right? If you watched the video on interest rates that I posted, when the Federal Reserve changes the central interest rate for the US, that affects everything in the market. Good economic news like the job numbers that gets posted when we're having record hiring in the country. These are all systematic things that affect the entire market, right? Now, of course, we're always concerned with the negative risks, but there are plenty of positive systematic risks that can help the market, just as negative ones can hurt the market. Okay? So systematic risk is distinguished from unsystematic risk, which is unique to an individual or a group of assets. Right? So a unique risk is something that only affects the firm that we're looking at, or potentially only affects a group of firms that we're looking at, like an industry, right? So an unsystematic risk is a risk that only affects an individual company, right? And that means you can have unsystematic risks that look like a labor strike. So for instance, last year there were widespread union strikes in the airline industry, in the car industry. We're seeing some labor unrest in Amazon right now during the crisis as workers try to organize because they don't think Amazon's providing them with enough protective equipment. You can think about unique risks as part shortages, as equipment problems. We saw Boeing over the last year and a half having major issues with one of its biggest planes that it's and had widespread grounding because of two major crashes. Okay. So anything that we think is only bound to affect an individual company and not the entire market is an unsystematic or unique risk. And so if we think about now in the context of how we calculate expected return in the last chapter, now we can see how we may have been using a measure of risk that was inappropriate. Right? So if we think about total return, this is the return that we actually get, okay? Actual return. It is the expected return plus some unexpected return. In other words, remember that our expected return doesn't have anything, it is not usually one of our actual outcomes. It's the average of running the action, taking the action 100 times or 1,000 times in a row. So then the difference between the actual return and our expected return is some unexpected portion. We're not sure whether it's going to be risk in a good way or a bad way, but the risk is going to affect our actual return. So expected return plus standard deviation or some factor of standard deviation gives us total return. Now, the thing about a portfolio was it allowed us to reduce our standard deviation. And so that meant that our measure of risk was probably inappropriate, and now we can see why. It's because this unexpected return that's generated by risk, it actually comes in two parts, a systematic portion and an unsystematic portion. And so really we should have been talking about actual return like this, that it's your expected return, what we think is going to happen, plus some factor of risk that comes from risk that affects the entire market, plus some factor of risk that comes from risk that only affects the individual asset itself, right?